Let me take a moment, before I say anything else, to ask you something. Think about the last time you checked your bank account and felt genuinely proud of what you saw. Not relieved, not anxious, proud. Like you had done something right, something deliberate, something that your future self would thank you for. For most people, that moment is rare. And if you are being honest with yourself right now, you know exactly what I mean. We live in a country where the average household earns a reasonable income, works hard for decades, and still arrives at retirement with far less than they expected. Not because they were lazy, not because they were unintelligent, but because nobody sat them down early enough and told them the truth about how money actually works, about how wealth is actually built, about the simple, unglamorous, deeply powerful rules that separate people who end up comfortable from people who end up dependent. I am not here to sell you anything. I am not here to tell you that you can retire next year or turn your savings into a fortune overnight. Anyone who tells you that is not your friend. What I am here to do is have an honest conversation, the kind your parents maybe should have had with you. The kind that feels a little uncomfortable at first, because the truth usually does. So let us start there. Let us start with the uncomfortable part. Most Americans are incredibly good at making money and incredibly bad at keeping it. Think about that for a second. We work, we earn, we spend, and then we work again to cover what we spent. It is a cycle that feels normal because everyone around us is living it. But normal, in this case, is not something to aspire to. Normal means working until your body gives out. Normal means hoping Social Security is enough. Normal means watching your children inherit stress instead of security. You deserve better than normal. And the path to better than normal is not complicated. It is just deeply misunderstood. Here is the first thing you need to understand. Wealth is not built by how much you make. It is built by the gap between what you make and what you spend, and then by what you do with that gap. That gap is your leverage. That gap is everything. And most people close that gap as fast as they open it. A raise comes in, and suddenly there is a new car in the driveway. A bonus lands, and the vacation gets upgraded. The lifestyle expands to meet the income every single time, and the gap disappears before it ever had a chance to grow into anything meaningful. This is called lifestyle inflation, and it is one of the most financially destructive forces in American life. Not because enjoying your money is wrong. It is not. But because there is a difference between spending intentionally and spending automatically. Most people spend automatically. They spend because they got used to a certain level of comfort, because they want to feel the reward of their labor immediately. Because frankly, the culture we live in is engineered to separate you from your money the moment it arrives. And so rule number one is this: spend less than you earn. Always. Without exception. Not dramatically less. Not monastery-level sacrifice. But consistently, intentionally, meaningfully less. If you earn $5,000 a month, live like someone who earns $4,000. That $1,000 gap, invested wisely and left alone, can change the entire trajectory of your financial life. This is not a new idea. This is the oldest idea in personal finance, and yet here we are. Now, once you have that gap, the next question is, what do you do with it? And this is where most people make their second critical mistake. They wait. They hold cash. They tell themselves they will invest when the market calms down, when they understand things better, when they have more to work with. And while they are waiting, time, which is the single most valuable resource in the history of investing, is passing. Let me tell you about something called compounding. You have probably heard the term, but I want you to really feel what it means, because most people understand it intellectually and ignore it emotionally. Imagine two people. One starts investing $500 a month at age 25. The other waits until they are 35 to start, also investing $500 a month. Both invest until age 65. Both earn the same average annual return. By the time they retire, the person who started at 25 has somewhere in the neighborhood of 2 to 3 times more money than the person who waited 10 years. They did not earn more. They did not take more risk. They simply started earlier. That 10-year gap is worth hundreds of thousands of dollars, sometimes more. And that is not a pitch. That is just mathematics doing what mathematics does when you give it enough time. Rule number 2. Start now with whatever you have. Stop waiting for the perfect moment, because the perfect moment is always behind you. But starting is only half of it. The harder part, the part that most people underestimate, is staying. Staying in the market when everything feels terrifying. Staying calm when the headlines are screaming. Staying the course when every instinct in your body is telling you to do something, anything, to stop the bleeding. I want to paint you a picture. The year is 2008. Markets are collapsing. Real estate is imploding. Banks are failing. The news is relentless and apocalyptic. People who had built up decades of savings are watching their accounts shrink by 30, 40, 50%. And the most natural, human, understandable thing in the world is to sell. Get out. Protect what is left. Wait until things feel safer. Millions of people did exactly that, and most of them never got back in at the right time. They sold at the bottom, held cash while the market recovered, and missed one of the greatest bull markets in American history. The market did not just recover from 2008. It went on to deliver extraordinary returns over the next decade, but only to the people who stayed. Only to the people who understood, on a deep level, that markets go down and markets come back up, and that the only way to guarantee a permanent loss is to sell during the panic. Rule number 3. The market will terrify you. That is part of the deal. Your job is to not let fear make your financial decisions for you. Because fear is the most expensive emotional state a human being can be in when it comes to investing. Now here is something that most people in finance never talk about honestly, and I want to talk about it directly. We are all emotional about money. Every single one of us. This is not a character flaw. It is neuroscience. The same part of your brain that processes physical pain also processes financial loss. Losing $100 feels roughly twice as bad as gaining $100 feels good. This is called loss aversion, and it is hardwired into every human being who has ever lived. Evolution built us to avoid loss, not to optimize for long-term growth. This means that your instincts, the very instincts that kept your ancestors alive, are working against your investment account. The thing that makes you a good survivor is also what makes you a bad long-term investor. Knowing this does not make you immune to it, but it does give you something enormously valuable. It gives you perspective. It gives you the ability to pause, recognize what is happening inside you, and choose a more rational response. Rule number 4. Know yourself, know your emotional triggers, and build a system that protects your decisions from your worst moments. Set automatic investments. Write down your long-term plan and read it during market downturns. Have a trusted person in your life who will talk you down from the ledge when panic starts whispering in your ear. The best investors in history were not the smartest people in the room. They were the most disciplined. Discipline is not talent. Discipline is a choice made over and over again, especially when it is difficult. Let me tell you about a different kind of mistake now. A subtler one. One that does not feel like a mistake at all in the moment. Think about a man, call him David, who discovers investing in his early 30s. He is smart, ambitious, and willing to learn. He reads everything he can. He watches the markets closely. And when he finds a company he believes in, a company with a great product, strong leadership, and a compelling story, he puts real money into it. The stock does well. He feels the rush of being right, and slowly, without realizing it, he starts equating investing with being clever, with beating the market, with finding the next big thing before everyone else does, so he starts trading more frequently. He researches obsessively. He moves in and out of positions based on news, earnings reports, gut feelings dressed up as analysis. And over 5 years, his returns are fine, decent. But when he actually calculates how he did compared to just buying a simple index fund and leaving it alone, he is behind. After commissions, after taxes on short-term gains, after the hours and hours of his life he spent managing it all, he underperformed a strategy that required almost no effort at all. This is not an unusual story. This is the story of most active investors. The research on this is overwhelming and consistent. The vast majority of individual investors who trade frequently underperform simple, boring, low-cost index funds over long periods. The activity itself is the problem. The more you do, the more you tend to hurt yourself. Rule number 5. Complexity is not sophistication. Doing more is not the same as doing better. Some of the most powerful investment strategies in history are almost embarrassingly simple. Buy good companies or broad market funds. Add money regularly. Leave it alone. Let time do its work. That is it. The financial industry will try to convince you that you need their complicated products and constant attention. You do not. You need patience, consistency, and the humility to resist the urge to tinker. Now I want to talk about debt, because debt is the other side of the wealth equation, and it is quietly devastating millions of American families in ways they do not fully appreciate. There are 2 kinds of debt. There is debt that works for you, debt used to acquire assets that appreciate, that generate income, that grow your net worth over time. A mortgage on a reasonably priced home in a growing area can be that kind of debt. A loan to start a legitimate business can be that kind of debt. And then there is debt that works against you, debt used to finance consumption, to pay for things that depreciate the moment you own them, to maintain a lifestyle your income cannot actually support. Credit card debt is the most destructive financial product available to ordinary Americans. Not because credit cards are inherently evil, but because they are designed brilliantly and deliberately to keep you paying interest forever. The average credit card in America carries an interest rate somewhere between 18 and 25%. Think about what that means. Every dollar you carry as a balance is costing you nearly a quarter of itself every single year. There is no investment strategy that reliably beats 20%, which means that paying off high interest debt is not just a financial decision. It is the highest return investment available to most people. And yet millions of Americans are building investment accounts while carrying credit card balances. That math does not work. You cannot outrun 20% interest with a 7% market return. Rule number 6. Pay off high interest debt before you invest heavily elsewhere. This is not glamorous advice. It does not feel like wealth building. But it is. Eliminating a 20% liability is mathematically equivalent to earning a 20% return risk-free. That is not something you can buy in any market. Now let us talk about something that sounds basic, but is actually one of the most powerful concepts in personal finance. The emergency fund. Every financial advisor in America will tell you to have 3 to 6 months of expenses saved in cash, liquid, accessible, boring. And most people nod politely and never actually do it. Here is what an emergency fund actually does. It keeps you from becoming a forced seller. When your car breaks down, when your roof leaks, when you lose your job, when life does what life does, if you do not have cash available, you will either take on debt or liquidate investments, often at the worst possible moment. The emergency fund is not about the emergency itself. It is about protecting your investment strategy from the unpredictability of real life. It is financial insulation. It keeps you from making desperate decisions under pressure. Rule number 7. Build your financial fortress before you build your empire. Get the emergency fund in place. Get the high-interest debt paid down. Create the stable foundation. Then invest aggressively, not the other way around. I want to spend a moment on something that does not get enough attention in conversations about money. Values. What you actually want your life to look like. Because here is the thing nobody tells you. Money without intention is just a number on a screen. And accumulating wealth without knowing what it is for will not make you feel secure. It will just make you feel rich and confused. The most financially successful people I have ever observed share one common trait. They know what they want money to do for them. Not vaguely, specifically. They want to retire at 60 and travel. They want to pay for their children's education without debt. They want to give generously to causes they believe in. They want the freedom to walk away from work they hate. Whatever it is, the clarity of purpose is what drives the behavior. It is what makes it possible to say no to the new car and yes to the investment account. It is what makes discipline feel like a choice rather than a punishment. Rule number 8. Get clear on your why. Write it down. Make it real. Then make every major financial decision through that lens. When you are tempted to spend impulsively, that clarity is what saves you. When the market drops and panic whispers in your ear, that clarity is what keeps you in your seat. Purpose is not soft. Purpose is the most practical financial tool you own. Now, we are deep enough into this conversation that I want to address something directly. Some of you listening right now are thinking about where you are. Maybe you are in your 40s or 50s and you feel behind. Maybe you made decisions in your 20s and 30s that you wish you could undo. Maybe you look at the math on compounding and feel grief instead of inspiration because you know that the best years of your compounding timeline are already behind you. I hear that. And I want to say this clearly and honestly. It is never too late to make better decisions. The best time to plant a tree was 20 years ago. The second best time is today. The principles we have been talking about, spending less than you earn, investing consistently, managing debt, building an emergency fund, knowing your purpose, these do not expire. They work at 40. They work at 50. They work at 60. The timeline changes. The strategy may need to be more aggressive or more focused. But the core approach is the same. Do not let where you are become an excuse for not moving. The only financial decision that cannot be recovered from is the decision to do nothing at all. Rule number 9. Progress over perfection. Every single time. You do not need to have everything figured out. You do not need to start with a lot. You need to start. You need to take the next available step, and then the one after that. Slow and steady is not a consolation prize. It is the actual strategy of almost every genuinely wealthy person in history. And now I want to bring it home. I want to spend these last few minutes talking about something that ties all of this together, because these rules are not really about money. They are about character. They are about the kind of person you decide to be when nobody is watching, when the market is crashing, when everyone around you is spending, when your patience is being tested, and your anxiety is telling you to act. The 10th rule, the one that underlies everything else, is this: think in decades, not days. We live in a world that is obsessed with speed, fast returns, fast results, instant feedback. The market moves in real time, and you can watch it tick up and down from your phone. This is both a miracle and a curse, because the human nervous system was not designed to watch its future oscillate by the minute without wanting to react. The investors who build real wealth are the ones who learn to think across a much longer frame. They buy a company not because of what it might do next quarter, but because of what it is likely to be in 10 or 15 years. They stay through downturns not because they enjoy losing money temporarily, but because they understand that temporary is the operative word. They make decisions not for the version of themselves that exists today, anxious, impatient, distracted, but for the version that will be sitting somewhere comfortable in 20 years, grateful for every small, disciplined choice that was made along the way. This mindset, this long game mindset, is not complicated, but it is rare. And it is rare because it requires something that modern life actively discourages. It requires restraint. It requires the ability to defer gratification, to say not yet instead of yes now, to value your future self as much as you value your present comfort. That is hard. It goes against the grain of everything the culture around you is telling you to do, but it is also the most direct path to a life with genuine financial freedom at the end of it. So here is what I want to leave you with. Not a formula, not a system, not a product. Just a perspective. Every single day you are making choices that are either moving you toward the life you want or away from it. Most of those choices feel small in the moment, unremarkable. Whether you put that extra money into savings or spend it, whether you sell in a panic or stay the course, whether you tell yourself you will start investing next year or you open an account this week. None of those individual moments feels like a turning point, but they are. Accumulated over years and decades, they are the difference between financial freedom and financial anxiety, between leaving something behind and leaving nothing at all. The people who build lasting wealth are not geniuses. They are not lucky. They are not operating with information the rest of us do not have. They are doing simple things consistently over long periods without drama. They are boring in the best possible way, and their accounts reflect it. You can be that person. Not a version of someone else, a better, more intentional version of yourself. Someone who understands that wealth is not a destination you arrive at in a single leap, but a direction you choose quietly every day for a very long time. The market will go up. The market will go down. Life will be complicated and unpredictable, and sometimes genuinely hard. None of that changes what is available to you if you are willing to stay patient, stay humble, and stay the course. That is everything. That is the whole thing. And if you remember nothing else from this conversation, remember this: the difference between where you are and where you want to be is not luck. It is not talent. It is not the right stock at the right time. It is a series of small, consistent, unglamorous decisions made over years by someone who was willing to think further ahead than anyone around them. That someone can be you, starting now.